Hey guys, thanks for joining me for this one. In this video, I just want to talk about dividend growth stocks and look at across my portfolio all the companies who've increased their dividends in the last year and the role that that's played in increasing my dividend income and the percentage of capital I get back from my portfolio on an annual basis. I want to start just by going through the companies who've already increased their dividend in 2023, and then I'm going to come back to this picture that shows the companies that have increased in the past 12 months and getting into the role that each of them play in my portfolio in compounding capital and dividend income over time. So right now it's February 18th, about 6 weeks into the year, and I already have a handful of companies who've increased their dividends already this year that I hold. The first one here is Ryokan. We got a 6% dividend increase earlier this week. Pretty big holding for me, so every year that Ryokan increases, that's more and more monthly income I get from that payout. The second one is Canadian Utilities. This was only about a 1% increase, and they already have about a starting 5% yield. They're investing in a bunch of different things. So this one is a bit more of a symbolical increase to keep their 50-year streak going. I hope it gets higher over time, but nonetheless, I'll take an increase wherever I can get it. Restaurant Brands International did a 2% increase. They've been increasing about a penny a year over the last 2 or 3 years. But prior to that, they were doing some pretty big increases, I believe. So hopefully after they scale the business a bit more, they can start accelerating their dividend growth. But similar to Canadian Utilities, still good to have companies, even if they're just increasing a couple percent, that can really help compound over time. Allied Properties, a 3% dividend increase. This one's interesting because Allied's been under a lot of pressure. Their yields gone from in the threes to in the sixes, mostly because of stock price depreciation. But given that, the business is still operating well enough and pumping up the same amount of funds from operation that they feel confident continuing to do these 2 to 3 to 5% dividend increases annually. So despite kind of the rhetoric out in the market, it was good to see that the board and the company still felt comfortable continuing on with their annual dividend increase and just continue to return even more capital to shareholders relative to their share price. And then my biggest stock, CN Rail, did about an 8% dividend increase. When I first bought this stock, I think their dividend was maybe 25, 26 cents. So it's up about 300%, just shows how much compounding can go on over a decade. But again, a pretty juicy, big, single high-digit dividend increase that we got here. So these are all increases just from this 1 week. Sorry, 1 week. Just from these 6 weeks since 2023 started. So we're off to a pretty good start, some pretty healthy gains in there. When I look just past 12 months now on dividend increases, these are some of the stocks in my portfolio that have had dividend increases over the last year. As a total percentage of my portfolio, about 70% of my portfolio has increased their dividend on a weighted basis. So that's phenomenal when I look at, what I count on for dividend growth. I'm deploying a lot more capital every year into the market to increase the dividend income I'm getting. On top of that, I'm reinvesting dividends that I am getting. And then this just serves as a third vector of compounding in my portfolio when I can have 70% of the portfolio actually increase organically the payouts that they're giving me on a per share basis. What I did is I kind of just calculated, I weighted averaged the incremental dollars I'm getting in from all of these increases. And now just from the changes, not any new money I put in the market or any reinvestment of these dividends on my previous shares, I'm getting paid out almost 5% more total income than I was 12 months ago. So that just shows if I did nothing, added no more money in, took all the income that I got out to buy things, pay bills, I'd be making 5% more almost now than a year ago, which is a really good starting point for your portfolio in terms of growing dividend income over time. Then obviously you layer on incremental investments, you reinvest dividends, stuff like that to get that 5% income growth to 10% to 15% to 20%. And you do that for long enough and for enough years, it really snowballs into a really big income stream for you that you can, rely on more and more. Now, I'll go through some of these stocks one by one just to give my thoughts on them. But one note here is First Capital cut their dividend during COVID and then slowly brought it back. And this past year, they actually doubled it. I thought that would be a big outlier, so I just left it out. But that's why these numbers are actually a bit understated because I'm not counting my First Capital Realty 100% increase on a technical basis, but it's really just returning to what it was before COVID. So I didn't think that was fair to kind of include that. Now, I just wanted to talk about some of these stocks a bit because in some of my videos, especially the ones that get watched more, it's really about covered call ETFs and high paying dividends. I think those play a great role in a portfolio, especially if you're able to manage a registered account where you don't pay tax up front, like a retirement account or whatever it may be. And that really enables you to just get a lot of capital now to reinvest in other opportunity areas of your portfolio, to grow your portfolio that way, not needing to count on those dividend increases or count on capital appreciation. So I do have a lot of those stocks, and some of them are even on this list, and they just got increases as well. But I think having core dividend growth stocks just are also a really important part of the equation of compounding dividend income over time. So having a stock like CNR, which on average has increased their dividend about 10% over the last 5 to 10 years, and I think over the last 20 years has a dividend increase CAGR of like in the teens, that really lets me rely on dividend growth down the road and higher dividend income down the road that I do not have to invest any more for, because the free cash flow from the business that isn't coming to me is getting invested in high ROI opportunities that I don't have to proactively seek out, which over time is spitting out more and more income for them to return to me as a shareholder. So I love how not all aspects of my portfolio and not 100% of my dividend income target has to be created on an annual basis from me. And I have stocks like CN Rail, stocks like P&G, TD, McDonald's, who are doing that internally for me already and giving me a head start on hitting my annual goals of dividend income. One thing that's interesting here is lots of my REITs, so it's RioCan here. I won't count First Capital for reasons previously explained, but Allied Properties as well. And typically, Canadian Apartment REITs also increases their dividend every year. These are companies that are in industries and sectors that some would say are not that advantageous, being in office real estate or retail real estate, but they've really created business models and capital structures that has enabled them to buck the growth trends and the sentiments of those industries by holding really, really strong assets that are not of the norm in those asset classes. And in addition to that, just operating very well, buying back shares when the stocks get too cheap and trading under net asset values. And they've been able to now increase their dividends over RioCan, more a short-term thing, but Allied over a very long period of time. CapREIT, I'm expecting them to potentially increase next week when they report, but CapREIT over a long period of time as well. So those businesses, while I'm not going to get the 10-15% dividend growth I'm getting on CN Rail, are big holdings for me. They pay me a lot every month, and I like kind of having that almost inflation hedge that they continue to pay me slightly more every year, and that's enough for me on those investments. The ones here that I try not getting too excited about because they're a bit more volatile are the royalty funds. So think Dividend Royalty here, or Diversified Royalty rather, and W Royalty, Pizza Royalty. I'll just highlight them in yellow. But these stocks are really reliant on just top line revenue of these businesses going up. It's no one doing, business modeling on how we can have a 5-year dividend growth or anything like that. It's ultimately just if more money's coming in the door, I'll get more money out as an investor. A&W's done probably the best job out of the three on just trying to make sure it goes step by step every year. But I fully acknowledge that these stocks are more for dividend now and income now, like I was alluding to with covered call ETFs and stuff like that. Whenever I get an increase from one of these, I really consider it just to be a bonus and a good sign that the business is healthy versus something I'm counting on year in and year out going forward. Ones that I'm really counting on more are stocks like Visa, Microsoft, TD, P&G, CN Rail. These are the companies that I'm buying at lower yields, but for the purpose of 10, 20 years from now, my yield on cost to compound over time and to be really strong accelerators of dividend income naturally in the portfolio to, offset the lower areas of dividend income, whether that be royalty funds or whether that be covered call ETFs that won't really go up over time to the same extent in terms of payouts because I'm paying for that income now and today. So that's kind of how I see my portfolio. I love having, combination of players and every player or stock has its own role, whether that's dividend growth over the long term, whether that's a bit of yield now, but then slowly increasing yield, something like Fortis, which has a 4% yield and increases 5 to 6% a year. Or maybe it's a stock like a covered call ETF or Northwest Healthcare REIT, where I'm getting a 7 or 8% yield today, and there's no line of sight to growth, but I'm able to reinvest 8% of the capital I have in the name into other growth opportunities, maybe some of the ones on this list, which will grow down the road. So I think having, sources of all three of these types of assets, whether it's high yield, mid yield with low growth, low yield with high growth from a dividend perspective, are all really important. So just crafting your portfolio and positioning your portfolio for long time dividend and income growth, which at the end of the day is what's important, at least to me in my portfolio. So I hope you guys enjoyed me kind of sharing some of my thoughts on dividends and dividend income stocks and the role they play in your portfolio. Would love to hear if you guys own any of these stocks, if you guys have any thoughts on dividend income stocks, or if you guys have any recommendations for other dividend growth stocks that I haven't really showcased here in my portfolio or in any of my other videos where I show my whole portfolio. But I'll see you guys in the next one.